Okay, so today we are going to discuss an important topic. It is about the measurement. So I think that you would recall when it comes to the conceptual framework, there we discuss the measurement aspect. So in fact, that was the last aspect what we have taken. So under the what do you call that, the component of conceptual framework. So there we discuss initially the objective, then the qualitative characteristics, then the elements, the recognition, uh, the definition, and finally the measurement aspect. So there we touch on the measurement. So today's discussion would mainly revolves around one of the contemporary measurements. So under the measurement, the current values. So we identify there are three valuation. So we call it the fair value, the value in use, and the current cost. So if you can recall, I'm just referring to the conceptual framework. So under that, there we have this fair value account. So in the today's discussion, we'll be looking at the fair value measurement. So we'll be discussing this in the context of SLFRS 13, the fair value measurement. So together with that, you can download the accounting standard, the SLFRS 13, and you can refer that for further uh, readings. So having said that, let us look at what is the expectation at the end of the today's discussion. Uh, so at the end of the today's discussion, you must be able to demonstrate that you have achieved these outcomes. The first one, that is about, you must be able to discuss the role of fair value. So what is the role of fair value in accounting? I told you it's a measurement. So we are going to but discuss them in detail. What is the measurement of fair value as a measurement basis? And then you must be able to describe the key aspects of the definition of fair value. So one of the main things that has introduced when it comes to this fair value measurement standard is it was about a precise definition on fair value. So if you can recall that at the times when you were doing your undergrad or when you were doing your A levels, even when I was doing my A levels, even undergrad, so we had a definition on fair value, right? But that definition is totally changed. There were certain labs, so there were certain kind of what do you call that? The deficiencies, I would say, the deficiencies in that definition. Because of that, a new definition was introduced in the SLFRS 30. So we are going to discuss each and every aspect of this definition, and we are going to see how it is different even from the previous definition what we had on this fair value. And then we are going to discuss about a practical approach to fair valuing the assets and liabilities. So there is a kind of a framework what we may adopt when we are come up with the instance where we need to fair value a particular asset or liability. So we are going to discuss what are the steps that involve in that particular framework, which determines the fair value of a particular asset or liability. And finally, we are going to discuss about the three valuation techniques that is being used to fair value a particular asset or liability, and also the importance of the input to this different valuation techniques. So each and every valuation technique would take certain inputs. So we are going to looking at what those inputs are, and also we are going to put them in hierarchy, and we are going to see what is going to be the most suitable input in a particular situation. So this is going to be our today's learning outcomes. The subject involved many accounting standards. Are we allowed to bring the standard book for the exam like in CA exams? No. So it's good that it's a good question that you have raised. You have observed that the many accounting standards you might have referred in this course, but I would say no. So we do not allow to take the standard book to the examination because our orientation is different. So, this is different from a professional qualification. You are pursuing a kind of academic qualification. And if I'm to talk that about your exams, so they are basically, I would say the depth that you would be tested on accounting standard would be very less, right? But rather we'll be looking at some kind of a theoretical kind of a thing. So even when it comes to a standard like this, we are not going to that much of depth, right? Uh, and also you would experience that at the end of this course, we are going to have a kind of a revision session. We are going to dedicate a particular day that is to conduct a kind of a revision session. So in that, we'll be discussing some review questions. We'll be discussing some question which may be more or less similar to what you'll be having in case of your examination. So hence, I do not find that it would be that much difficult, that much required for you to bring the accounting standards, because we are not going to touch on that much of depth in the accounting standards because our orientation is different. So we'll be looking at some of the contemporary issues. So hence, what is pretty much required is to have a kind of understanding on the theoretical concepts, what we would discuss in the lecture, and that is what the expectation. It's all about understanding the rationale. So that is something what you are expected. So even when it comes to the conceptual framework, we have discussed the basic aspects, and we have discussed the underlying rationale. So that was the approach we have taken. So if you take the last time session, what we took, again, it was not something to do with the accounting standards the most of the time. So we have discussed about the disclosure and the regulations involved. So similarly, but when it comes to today's session, yes, it is based on a particular standard, but it is not that much required for you to take this accounting standard, because we are not going to test them in depth in a nutshell, right? Okay. Right. Then the lesson outline. So today's lesson outline, this is how I have planned the presentation. First, I'll be taking you through the role of fair value in accounting, as it was even highlighted in the learning outcomes. We'll be looking at what is the role of fair value. Then we'll be looking at some of the important aspects in the fair value measurement standard. It is about the definition, the valuation techniques, and fair value hierarchy. So that is how it works. Okay. So having said that, this is the starting point. As I stressed earlier, this is the slide, exactly the same slide I have taken from the conceptual framework. So in the conceptual framework, you have witnessed, you had this measurement basis. So you have the two measurement bases, what we call that the historical cost and the current value. So historical cost, I think it is pretty much familiar to you. So especially when it comes to asset, the historical cost is a consideration that is paid to acquire or create an asset plus the transaction cost. For example, that if you take the PP, the LK 16, in that particular case, initially you need to recognize or initially you need to measure, I would say, a particular PP item at its cost. So therefore, the cost application is there. So similarly, if I talk about the investment property standard, they are also at the initial recognition. You need to measure the investment property at cost. Even if you take intangible asset, that is same. On the initial recognition, you need to measure a particular intangible asset at its cost, right? And even if you take the other example, you can think of many. You can think of the asset side, and you can think of certain example. So the point is that when it comes to even the today's environment, even in 2020s, So still we are using this historical cost. So that is the power of this historical cost concept. So in fact, when it comes to this historical cost, it is there are certain criticisms, right? And as well as there are certain positives. So when it comes to one of the major criticisms on this historical cost is that, so it is about the relevance. If you talk in terms of the qualitative characteristics, so when it comes to this historical cost, the information what it may provide may not be relevant to the today's environment. So it is based on something that happened in the past. So therefore, the relevance of the information that is provided is questionable. But at the same time, if you look at the faithful representation, if you think in terms of the faithful representation, so here the reliability is quite high. So here, when it comes to the historical cost, it records a particular transaction at the true value, the value at which that particular asset was acquired. So hence, it is a very reliable thing. So the reliability is there. So the faithful representation is quite high. So because of that reason, yes, still the historical concept is there in the today's environment. So it is pretty much appreciated. So it is applicable for the asset. It is applicable even for the liabilities. So if you think about the liabilities like if you have obtained a kind of a bank loan, initially it needs to be measured at the fair value. You know, it's a financial instrument, being a financial instrument, but subsequently, when it comes to the subsequent measurement, you know, it has to be measured at the amortized cost. The amortized cost means it's a historical cost. So if you take the debentures issued, the same applies. So the subsequent measurement, you are going for this amortized cost. And also if you take a kind of a obligation for, say, the income tax payable, if you take, and even if you take the accrued expenses, so all these things are recorded at the historical cost. So hence, even considering the liabilities, still the historical cost concept is there. So if you take the latest accounting standard, that is the SLFRS 9, the financial instrument, in that standard also it refers to this amortized cost. So it refers to the amortized cost. Even if you take the lease, the latest standard, so not in the initial recognition, but in the subsequent measurement, so the amortized cost is there. So it's a historical cost. So therefore, still the historical cost is applicable. But when it comes to the current or the contemporary business environment, so there's a tendency, though the historical cost concept is being used, there's a tendency that we are simply moving away. We are trying to moving away from this historical cost. The main argument why we are moving away from this historical cost is the matter what I raised earlier, that was the relevance. The most of the people, the accounting community would question that the historical cost, it is not relevant to the today's environment. So therefore, in order to enhance the relevance, so it is advocated better to go for the current values. So hence, the accounting community, the majority of the accounting community today are in favor of this current values rather than the historical cost. So when it comes to the current values, basically it represents the expectation, the current expectation of the market participants, or even it could be entity specific expectation of the future cash flows of a particular asset or liability, right? The current value is, it reflects, it can be a kind of entity specific expectation, or sometimes it may be a kind of a market expectation, the current market expectation of the future cash flows of a particular asset or liability, future cash flows associated with a particular asset or liability. එතකොට අපි current values කියලා කියන්නේ මොකක්ද? current values වලින් පෙන්වුම් කරන්නේ වර්තමාන තත්ත්වය. current expectation එක. ඒක market participants ලාගේ වෙන්න පුළුවන්. නැත්නම් ඒක entity specific expectation එකක් වෙන්න පුළුවන්. Right? About the future cash flows. Right? So they are emphasized on two things. What is that? The market, the current expectation of the market participants, current expectation of the entity, or I would say entity specific current expectation. So what is that? So that is the most important thing what you need to identify. So today the entire discussion would revolves around the market expectation of the future cash flows associated with the particular asset or liability. So out of the three valuation bases, the valuation methods that is provided under this current value, if I am to take this fair value, remember fair value is a market-based measurement. So what we are going to discuss today, it's a market-based measurement. So hence, so if someone asks you what is fair value, the fair value would reflect the current market participants' expectation of the future cash flows. වෙළඳපොළ සහභාගී වෙන පාර්ශවයන්ගේ යම්කිසි වත්කමක් හෝ වක්කීමක් සම්බන්ධයෙන් වක්කීමක් හා බැඳුණු අනාගත ආර්ථික ප්‍රතිලාභ සම්බන්ධයෙන් තියෙන expectation එක තමයි fair value එකක් කියන්නේ. Right? So fair value is what we call, it is the price that you would receive if you sell an asset today. Right? සරලව කිව්වොත් fair value එකක් කියන්නේ ඉදිරියට අපි සාකච්ඡා කරනවා යම්කිසි asset එකක් අපි අද වික්කොත් අපිට කීයක් හම්බ වෙනවද කියන එක. එතකොට යම්කිසි asset එකක් අද වික්කොත් කීයක් හම්බ වෙනවද කියන්නේ ඒතර market එකේ අපි ඒක වික්කොත් අපිට ලැබෙන මුදල. ඒතර market එකේ මුදල තීරණය වෙන්නේ කොහොමද? ඒ market participants ලා කල්පනා කරනවා ඒ කියන asset එකෙන් generate කරන්න පුළුවන් future economic benefits consider කරනවා. එතකොට fair value එකේ ඇත්තටම reflect වෙන්නේ මොකක්ද? It is about the current expectation of the market participants of the future cash flows. Right? So why do they pay that price? So it's because they are having some expectation about the future cash flows associated of this particular asset. So let's say that being the entity, you sell a motor vehicle in the market today, the motor vehicle that you have. Or let's say you are selling a land that you have in the business today in the market. So once you sell that, the market participants would purchase that. Then why would they purchase? That is to use, that is for a particular use. So therefore, the price what they would pay for this particular land would reflect the expectation, the current expectation of the market participants on the future cash flows of that particular asset. Now it should make sense, right? Then that is what we are going to discuss. So most importantly, the fair value, it's a market-based measurement. So then when it comes to the other two valuation bases, so how I can distinguish that from the fair value, it is the value in use and current cost, it reflects the current expectation. It is a entity-specific current expectation. Earlier, it was a market expectation, market participants expectation. Now it is an entity-specific expectation. So what a particular entity, what is the idea, what is the expectation that a particular entity would have about the future cash flows of a particular asset or liability. So මේ value in use සහ current cost කියන්නේ එතන reflect වෙන්නේ market එකේ තියෙන expectation නෙමෙයි. යම්කිසි entity එකකට යම්කිසි මුදලක් ගෙවන්න ලෑස්ති නම් යම්කිසි වත්කමක් වෙනුවෙන් උදාහරණයකට එතකොට ඒ වත්කම තුලින් ඒ entity එකට generate වෙන future economic benefits මොනවද? The value in use කියන්නේ you simply forecast the future cash flows of a particular asset of yours and you get the discounted value, and that is the value in use. So therefore, the value what you would determine today would reflect the entity's expectation about the future cash flows associated with that particular asset. So that is the value in use. Then when it comes to the current cost, again, that is the price that you would have to pay in order to replace the service capacity of that asset. Then why are you ready to pay a particular price to replace the service capacity of that asset? So from an efficient market point of view, if you think, so that would be the value of the future cash flows that is expected to be generated by that particular asset. So therefore, the distinction between this fair value and the rest of the measurement is that the fair value would represent the market participants' current expectation of the future cash flows, while the value in use and current cost would reflect the entity's current expectation of the future cash flows. So that's the most important thing what I need you to understand from the beginning, right? Okay, right. So having said that, let's come to the very first aspect what we want to discuss in the today's discussion. The first learning outcome, I would say, what is the role of fair value? What is the role of this measurement base? So we have discussed what is fair value simply. Then what is the role of this fair value in account? So as we agree, as we saw, it's a measurement base. So therefore, when you use this measurement base, the measurement base would require at 2 points, I would say. The first time where you need this measurement base, it is at the initial recognition. So if you take a typical accounting standard, you would find that the initial recognition, the measurement at initial recognition. For example, if you take the PPE, it says that an item of PPE at the initial recognition must be measured at its cost. So similarly, there can be certain accounting standards would say that at the initial recognition, you need to measure this transaction or asset or liability at its fair value. එතකොට PP standard එකකින් කියනවා යම්කිසි asset එකක් initially measure කරන්න කියලා cost එකට. එතකොට ඒ විදිහට සමහර accounting standards තියෙන්න පුළුවන්. ඒ accounting standards කියනවා ඇති සමහර transaction, සමහර asset liabilities at the initial recognition need to be measured at fair value. Can you think of accounting standards that would require us to measure at the initial recognition at its fair value? So there can be some accounting standards, yes, if you think of. Yes, you can add to that. Samaha accounting standards තියෙනවා. ඒ standards වලින් කියනවා අපිට initial recognition එකේදී measure කරන්න යම්කිසි asset එකක් liability එකක් at its fair value කියලා. එහෙම standard can you recall? So if I'm to give you one example, if I'm to start, right? What about the SLFRS 9 financial instrument? If you take that standard, it says that all the financial assets and liabilities at initial recognition needs to be measured at its fair value, right? So it is an accounting standard, SLFRS 9. It requires all the financial assets and liabilities to be initially measured at its fair value. Then that is a kind of a service the fair value standard would provide. So that is the role of fair value. So it supports us the measurement of transaction at initial recognition. So the SLFRS 9 would require us to measure the financial assets and liabilities at fair value. So we does. So that is an example that comes under the first one. So similarly, if you think of other accounting standards, okay, we'll see. So LKS 41, biological assets. Yes. So when it comes to biological asset, it says that when it comes to this, the biological asset and even the agricultural produce, initially you need to measure them at the fair value less transaction cost. At fair value less transaction cost. So in that also, it refers to the fair value. Yes, it's a very correct one. It's a classic one. The LKS 41, the agriculture standard requires us to measure the biological asset and the agricultural produce at its fair value. So it is another standard which would require. So therefore, the point is that there are certain accounting standards would require us to measure the assets and liabilities at fair value in the initial recognition. So that is one of the role of fair value. So it would help us in the measurement of transaction at initial recognition. The second thing is that the subsequent measurement of assets and liabilities in the financial statement. You would have seen that in certain accounting standard, it would require us to measure the assets and liabilities or the transaction subsequently at fair value. So can you think of some examples where the subsequent measurement you are required or you are allowed to measure at fair value? Again, if I'm to take a kind of example, I'm taking SLFRS 9 again, the financial instrument. In that standard, you would find that the financial asset at fair value through profit or loss, or financial asset at fair value through other comprehensive income investments. So it's basically two categories of investment, right? I'm not going to take them in detail. The financial asset at fair value through profit or loss investment, financial asset at fair value through other comprehensive income investments, you would require to measure them at fair value. You want to measure them at fair value. So therefore, at each reporting date, you need to measure these two categories of investments at its fair value. So that is another example. Even that is applicable for financial liabilities. There are certain financial liabilities where you need to measure them at fair value. So especially like derivatives. So that is the case. That is one standard. Yes, you are giving an example, investment property. Yes, very correct. When it comes to investment property, you have seen that the subsequently you can go for the fair value model. Very correct. So in that you refer to the fair value. And again, good example, the PP, the classic one. So you have seen that under the PP, subsequently you can go for the revaluation model. So under the revaluation model, you know, you're valuing your asset at its fair value. Valuing assets at its fair value. So if you take the revaluation option, that is also very correct. Then the other one, yeah, investment of find fair value through profit or loss and fair value through other companies. Yes, very correct. So you have taken them very nice. That's what I good. So now you would understand that that is another role of fair value. So it's all about measurement. You are simply classifying this measurement into two: the measurement at initial recognition, measurement at subsequent measurement. And also the other instance, which we cannot exactly put them as subsequent measurement or initial recognition, but it is a kind of a unique instance, I would say. It is about the determination of the recoverable amount of asset, impairment testing. So, you know, according to this impairment of assets standard LKS 38, when you're going to take an impairment test, there you need to compare the carrying amount of an asset with its recoverable amount. So when it comes to the recoverable amount, what is that? That is the higher of the fair value less cost to sell and the value in use. So out of the two values, you know, when it comes to a particular asset, there are only two ways. There are only two ways that you can realize the value of that asset, realize the carrying amount of that asset. Either you need to sell that. වත්කමක් ගත්තොත් ඒ වත්කමට රිකවර් කරගන්න පුළුවන් ක්‍රම දෙකයිනේ තියෙන්නේ. එක්ක ඒ වත්කම විකුණන්න ඕනේ, එහෙම නැත්නම් ඒ වත්කම දිගටම භාවිතා කරන්න ඕනේ. So if you have to sell that asset today, that is the valuation, what we call the fair value less cost to sell. Then the other option is that if you wish to continue to use it, the valuation what you get, the future cash flows, you get them discounted and establish the value in use. So what we referred earlier. And you know, the value in use is the entity-specific expectation, entity-specific current expectation of the future cash flows, right? So hence, it's an entity-specific one. But there also, you can remember that if you sell that asset immediately, you got the fair value less cost to sell. And there you have the fair value. And that is what we refer over here. So when we performing the impairment test, when you are performing the impairment test, there we may refer to the fair value. So therefore, that is another important role of fair value. So hence, basically, we can identify there are three roles to this fair value, right? So it's a measurement of transaction at the initial recognition, the measurement of transaction subsequently, and also the determination of the recoverable amount. So there you have an important ingredient, that is the fair value less cost to sell, right? Hope it is clear to you. So if you are not clear with that, yes, you can raise the concern.
There is a question,
Anything that you would like to get clarified from the discussion what we had so far?
Yes, there's a question, sir.
I'm hearing you hardly.
Yeah, there is a question, sir.
Yeah.
Actually, normally the financial statements shows the fair value of the non-current assets part. When we
Can you
take into
speak a
the
little louder? I'm hardly hearing you. Can you speak a little louder, please?
now it's okay, sir.
Yeah, now it's fine. Yeah.
Okay, sir. Normally in the financial statement part, where fixed asset, non-current assets part, the fixed assets are taken into account at the fair value, sir. So when it comes to the revaluation part, what will happen to the value, sir? That is, that will be treated as a fair value or the current value, sir? The revalued amount.
Yeah. You are taking it as at the fair value. Yeah, you are revaluing the asset to its fair value. That is for the PPE items, the property, plant, and equipment items. Yeah.
After the revaluation, it will be treated as a fair value.
Yeah. Once you revalue, basically you are revaluing that to the fair value, no? So it's a market value. You are revaluing your asset to its fair value.
Okay.
Yeah, that's what we do.
Okay, sir. That is
right. Okay, yeah. Good.
Thank you, sir.
Yeah. So when it comes to this PP standard, so we can go for the revaluation model if we find that the cost information is largely different from the current market prices. The option is there for you to go for the revaluation model. So if you choose to go for that, you need to revalue the entire class of asset. So if it is land, the entire class of land has to be revalued. So you are revaluing that to the market value. So that is the fair value. Yeah. That's how we do. In other words, it's current market price. Yes, very correct. The fair value is the current market price. So that's why we are saying that it reflects the current expectation of the market participants. So in simple words, it's the current market price. So the fair value is the current market price. Exactly correct. Right. So here we have an activity, the application of fair value based measurement. Right. So here we are supposed to come up with certain standards which would require us to measure them at the initial recognition and measurement after the initial recognition. So if I'm to take one example, as we discussed earlier, we discussed several. So let me take that. That was about SLFRS 9. No? SLFRS 9. So measurement at initial recognition, yes, you need to measure all the financial instrument, all the financial assets and liabilities at its fair value, right? All the financial instruments, I would say, right? Instruments, you need to measure them at fair value. Then even you have seen that, yes. So there are some financial asset at, as you mentioned, financial asset at fair value through profit or loss, investment, and financial asset at fair value through other comprehensive income, investments, and needs to be measured at fair value. And also you mentioned about PPE, that is LK 16. So when it comes to the PPE, not initially we measured at the cost, but subsequently, yes, you can go for the revaluation model. revaluation model. So similarly, you mentioned the LKS 40. LKS 40, what is that? The investment property. Yes, there also you can go for this fair value model. Fair value model. So there is another instance. So if I ask you what is the difference between the revaluation model and fair value model? So you might have seen that in LKS 16, they talk about revaluation model. LKS 40 investment property, they talk about the fair value model. What's the difference? So what is the similarity? Let's start with that. What is the similarity in the fair value model and the revaluation model? Have you thought of? So in both the instances, you are measuring your asset at its fair value. So if you go for the revaluation model, so let's say that it is your motor vehicle, you are measuring them at fair value. Under the fair value model, your land and building, you would be measure them at fair value. So that is the similarity. Under the revaluation model and the fair value model, you measure your asset at its fair value. Then what is the difference? So under the revaluation model, having fair value, having taken the asset to its fair value, then you continue to depreciate that. So if you take the motor vehicle, having revalued that at its fair value, you are going to depreciate that. But under the fair value model, you are not going to depreciate that. You're going to stop the depreciation at the point where you switch to the fair value model. At each reporting date, what you are going to do, you are going to take the fair value. And the gains and losses, you're going to take them to the P&L. So that's how it works. But under the revaluation model, once you revalue that asset, you continue to depreciate. So that is a difference. And even the revaluation gains, the first time, gains that goes to the OCI, losses goes to the P&L. But under the LKS 40, the fair value gains or loss, whatever it is, it goes to the profit or loss. That is another difference, right? So this is just to think of. Then you mentioned about, yeah, LKS 16 mentioned, 40 mentioned, yeah, what else? Yeah. So that's what you mentioned so far, right? Now you can think of other. And also you mentioned about the biological assets, no? The LKS 41. Let me take that, LKS 41. It is about the agriculture standard. According to that, initially you need to measure the biological asset and the agricultural produce at its fair value, and subsequently also the biological assets, you need to measure them at fair value less cost to sell. So here also the fair value less cost to sell, here also fair value less cost to sell. So that is another standard. So likewise, you can think of several other. So at that, what are the other standards that you have come across? So there would be like over 100 references in different standards. So around 35 or the standard, I would say, refer to this fair value based measurement. Can think of, yeah. So what is the treatment for inventory? Good. When it comes to the inventory, we are going to measure them initially. It is at cost, right? But subsequently, it has to be the cost or net realizable value. Then the cost is pretty much obvious. Cost is pretty much obvious. Then what is the net realizable value? It is net realizable value is a entity specific expectation of the future cash flows. So therefore, it is not fair value. How it is different? The net realizable value, how it is different from the fair value? Fair value is a market-based measurement. But net present value, if you take that, it is an entity-specific expectation, right? So that is the amount an entity would expect to obtain, right? එතන inventory වල අපි net realizable value එක සම්බන්ධයෙන් කතා කරොත් එතකොට එතන තියෙන්නේ යම්කිසි ආයතනයක තියෙන තමන්ගේ inventory සම්බන්ධයෙන් තියෙන expectation එකක්. අපි ඒ ටික වික්කොත් අපිට කීයක් ගන්න පුළුවන් වෙයිද කියන එක. ඒතර එතනදී අපි කතා කරන්නේ නැහැ යම්කිසි market එක්ක විකුණන තත්ත්වයක්. Right? ඒතර market එක කියන්නේ there are independent, willing, knowledgeable, and able buyers and sellers. Right? So that is the market. But here we are not referring to the market. So it is about just selling that to a particular customer or something. So it's about the entity specific expectation. It is not the fair value. Yes. So that is one difference. And also another difference, what they highlight, it is also does not reflect the current expectation. Instead, it reflects the future expectation. So in fair value, we talk about always the current expectation. But when it comes to the net realizable value, it talks about expected selling price minus expected cost to sell minus expected cost to complete. So hence, it refers to a kind of a future scenario. So in that basis, it reflects the future expectation. So that is another distinction why it is not fair value. So there are two distinctions I talk about. One is it is entity specific. The other one is it is future expectation. But when it comes to the fair value, it's a market based current expectation. Right? Good. So it's a good question. So most of the time, it is thought that net realizable value is a fair value. No, it's an entity specific one. Yeah. If we use revaluation model to the asset, is require revalue every year? No. So if you go to the revaluation model, there is no such requirement for that. So the only guidance that is provided in the standard is that it says that if the market prices are significantly different from the cost, you are encouraged to go for the revaluation model. But once revalued, if you find that yeah, the market price is not significantly different, then you don't have to revalue it year on year basis. So therefore, there is no such requirement. So once you revalue, you can, if you can go with that price, if the market price is not different significantly, you can simply go at that price maybe for another 5 years. So, but if you find that, so whatever the asset, the market price is changing frequently, then you might have to revalue it sometimes on a yearly basis. But most of the time, that is not the case. But when it comes to the fair value model, basically, if you go to the fair value model and each and every year, at the end of each reporting date, sorry, at the end of each reporting period, or at each reporting date, you need to fair value that. So that is another distinction, what I failed to mention earlier. Yeah, it's a good question. Right. So likewise, you can think of several other accounting standards, right? So if I'm to add another one, so the frequently discussed one, SLFRS 3, the business combination. So if you can recall, in the business combination standard, it says that when you acquire a particular entity, all the assets and liabilities of that acquiring, all the assets and liabilities of that acquiry need to be measured at fair value. So therefore, it is the initial recognition. එතකොට අපි SLFRS 3 ගත්තොත් එතන කියනවා අපි යම්කිසි ව්‍යාපාරයක් acquire කරොත් ඒ ව්‍යාපාරයේ තියෙන සියලුම assets and liabilities fair value එකට measure කරන්න කියනවා. So what it stands for? Fair value, financial asset fair value through profit or loss, financial asset fair value through other comprehensive income. Yeah, it's a good question. Yeah. So when it comes to this financial asset at fair value through profit or loss and financial asset fair value through other comprehensive income, yes, this is basically considering an investment that you make in. So let me take a kind of sheet. Let me take an Excel sheet. Right. So we found to share. Okay, so here basically, when it comes to a kind of a investment, let's say that investment in shares, basically you make investment in shares, or we call it equity instrument, right? Or debt instrument, right? Instrument, equity instruments or debt instrument. So when it comes to this investment in shares or equity instrument, basically we classify this investment into two categories. One is called financial asset at fair value through profit or loss. Financial asset at fair value through profit or loss. The other one is called the financial asset at fair value through other comprehensive income. Then what is the basis for this classification? The basis is that is your intention. What is the basis? It depends on your intention, right? So your intention is to trade. If your intention is trading, what do you mean by trading? You're purchasing shares and you're selling the shares with the purpose of making a profit. That is what we call the trading. If your intention is trading, you buy shares and you sell shares, right? So you have some cash reserves with you, so therefore you want to make something out of that. So hence you go to the share market, you purchase the shares and buy the shares. So if you are purchasing shares with the intention of trading, that is called the financial asset at fair value through profit or loss investment. While the other one is that if your purpose is other than trading, and that is called the financial asset at fair value through other comprehensive income. So what are the instances where you have a purpose other than trading? If we are to take some example, there may be some investors who would primarily concern with the dividend. So they might invest in shares with the intention of making a dividend income. If that is the case, their purpose is not trading. They don't want to buy and sell shares, but instead they want to buy and keep the shares and to earn a dividend income. So if you have such kind of intention, you need to classify your investment as financial asset at fair value through other comprehensive income. And if I have to give another sensible one, so it can be a strategic investment. In the sense, you may be simply in the process of accumulating the shares. Let's say that you are entity A and you have a kind of a strategic purpose that you want to be in control of entity B. If you are to do that, what you need to do, you need to take more than 50% of the shares. You need to have more than 50% of the shares. So therefore, you are not going to purchase entire 50%. You can't do that, right? In most of the instances. So therefore, you may be simply accumulating the shares. So now you may be purchasing 5% of the shares. After some time, you may be purchasing 10% of the shares. Likewise, you may be simply accumulating the shares. And your purpose is not trading. You don't want to buy and sell the shares, but instead, you want to simply accumulate the shares, and one day you want to be in control. So that is another purpose of investment, and it is other than trading. So if that is the case, your investment is financial asset at fair value through other comprehensive income, right? In these two instances, it is said that, let's say that you're purchasing 1,000 shares on 1st of April 2021, or let's say in 2020, you're purchasing 1,000 shares of this entity B at rupees 50 each. And you know, when you are doing transaction in the share market, there's a transaction cost. Let's say the transaction cost is 2,500 transaction cost, right? तर මේ වගේ instance එකක් අපි හිතමු shares 1000ක් ගත්තා මේ කියන දවසට. And you purchase them at 50. And at that date, that is going to be the fair value. ඒක තමයි fair value. The trading is a basic operation of the company. No. You're getting it wrong. I'm not referring to the primary business activity. The primary business activity of the entity is different. Let's say that you are running a chain of supermarkets. That is your primary business activity. So here we are talking about your purpose relating to a particular investment. So you are having some cash reserves and you are making a kind of investment, right? So that investment, purpose of the investment is the trading, right? It is not the primary business activity, right? It is about the purpose of your investment. So in that, if this happens, so what you do, you would simply recognize initially this investment at this value. So this is your initial recognition. So you recognize them at fair value. So if you have paid cash, so the cash gets credit 50,000 and 50,000, that is the investment in it. And that particular investment in entity B. And that particular investment is a kind of fair value through profit or loss investment. And then what about this transaction cost? So if a particular investment is classified as financial asset at fair value through profit or loss, the transaction cost need to be expense. So therefore, you need to charge this 2,500 to the P&L. So you paid 52,500, you charge 2,500 to the P&L, 50,000 is the investment. So this is about the initial recognition, right? So instead, if this particular investment is classified as fair value through other comprehensive income, අපි તો මේ ඉන්වෙස්ට්මන්ට් එක ක්ලාසිෆයි කරලා තියෙනවා fair value through other comprehensive income. එහෙමනම් කොහොමද අපි recognize කරන්නේ? If that is the case, this is going to be your investment. So if a particular investment is classified as financial asset at fair value through other comprehensive income, initially you need to recognize them at the fair value plus transaction cost, 52,500, and it is cash, and that is 52,000. Now you can note a simple difference. If a particular investment is specified as fair value through profit or loss, the transaction cost goes to the P&L, and here the transaction cost is capitalized. And when it comes to subsequent measurement, let's say 31st March 2021, so again you require to measure them at fair value. So let's say you have the 1,000 shares with you, and the fair value of this share, you go to the share market on this date and you refer to the BPLC, and when you look at the market price, if you find it is 60, that is going to be the fair value per share. So when you come to the investment, now you can see that your investment has gone up to 10,000, 1,000 into 60, that is 60,000. So initially you recorded at 50,000. Now you need to put additional 10,000. That should go to the P&L. Sorry, that should go to the investment in B, and it goes to the P&L. Sorry, it goes to the P&L. So that's why we call it financial asset at fair value through profit or loss. You can see that the gains and losses would go to the P&L. So at each reporting date, you need to remeasure your investment at its fair value. So once you measure that, whatever the gains or loss that is there, it must be taken to the profit or loss. That's why we call it financial asset at fair value through profit or loss. Then in this particular case, you can see that it was initially recorded at 52,500. So therefore, the increase is only 7,500. And this time, that 7,500 should go to the OCI, other comprehensive income. And that's why we call it financial asset at fair value through other comprehensive income. This is about the subsequent accounting as well, right? I'm just taking you through. Then according to the intention of the company, then can change the recognition. Yeah, it is said that, so if you take this financial asset at fair value through other comprehensive income, it is a irrevocable election. So once you made that, you cannot change it. That's why it is said that it is an irrevocable election. So if you decide once a particular investment to be financial asset at fair value through other comprehensive income, even subsequently, if your intention change, no, you cannot switch. But if you have taken this option, financial asset at fair value through profit or loss, this is what we call the default option. So in later point in time, if your intention change, yes, you can switch to financial asset at fair value through other comprehensive income. But that is not the case if you have taken this option. So you cannot switch. So this is a irrevocable election. That's why we say that you need to take it from the very beginning, and once you take that, you cannot change it. So that's how it is said, right? Okay, so it is just to explain you with this, right? It's something out of the scope, but still I feel it is important. That's why I have taken you and appreciated you are coming up with questions, right? Good. Right. Now we are looking at the accounting standards, what would require us to measure at fair value at the initial recognition as well as the measurement after recognition. So here, in fact, we have identified some of the accounting standards. In fact, the most of them we have taken over there. You can see the SLFRS 3, business combination, LKS 16, we discussed, LKS 36, impairment of asset, intangible assets, financial instrument. So this is wrong. It must be financial instrument, right? Earlier we had that LKS 39, financial instrument recognition and measurement, but now we have SLFRS 9, that is only the financial instrument. But it is about the recognition and measurement aspect being discussed. Investment property, yes. Agriculture, yes. And also here we have identified another one. It is non-current asset held for sale. So if you decide after some time a particular non-current asset to be sold, so if you have decided on a particular reporting date, from that date onwards, it is no longer a non-current asset, but rather it's a non-current asset held for sale. So in that particular instance, at the point you classify a particular non-current asset as non-current asset held for sale, you need to measure them at the fair value less uh, cost to sell, fair value less cost to sell. So there also you refer to the fair value. So that is why we say that non-current asset held for sale. And the employee benefits, also in the employee benefits standard, we have the planned benefit asset and the planned benefit obligation. So there we need to remeasure at each reporting date to its fair value, the planned benefit asset as well as the planned benefit obligation. So there also we refer to the fair value. Then intangible assets, in the subsequently, we can measure the intangible assets at its fair value. Intangible assets at its fair value only if there is active market. Only if there is active market. So intangible assets වලත් ඇත්තටම අපිට ඉඩ දෙනවා measure කරන්න fair value එකට ඒක subsequent measurement වලදී එහෙම නම් measurement after recognition වලදී නමුත් එතන condition එකක් තියෙනවා එහෙම කරන්න නම් there must be an active market. What do you mean by active market? So there is a kind of a frequent transaction in the markets and the price information is available frequent on a frequent basis, right? So that is what we call the active market. But when it comes to this intangible asset, the most of the intangible asset do not have the active market. So that is another constraint. If you can remember, even in the last class, I mentioned that. But still it is allowed. The revaluation model is allowed only if there is an active market. The rest of the standards, I think we discussed the impairment of assets, the recoverable amount, we discussed that, right? So here also you can see that we have classified them. The SLFRS 3, sorry, it's a mistake over here. SLFRS 5, yes. The SLFRS 9, financial instrument, mandatory for some financial asset. LK 16, no, allowed. Employee benefit, yes. Intangible assets, allowed. Investment property, yes. Option, yes, yes. Right? Right. So these are some of the examples. So now you can understand the importance of this fair value. As I told you that nowadays there is a tendency that we are moving towards the fair value. We are moving away from the historical cost and we are moving towards the fair value measurement. Then when it comes to this SLFRS 13, I told you from the very beginning that when it comes to this fair value measurement, the guidance is provided in the SLFRS 13. But thereafter, when we discuss about the role of the fair value measurement, we have seen that it helps us the measurement in initial recognition, and also it helps us the measurement in subsequent, in the instances subsequent to the initial recognition, and also in the recoverable amount determination. So that was the role of fair value. In those instances, you have seen that we always talk about the other accounting standards. So the SLFRS 3, 5, 9, 16, likewise, we discuss about the other accounting standards, right? So then you must be convinced that when it comes to this SLFRS 13, the main objective of this SLFRS 13 is not to dictate when to measure the fair value. This is the most important thing that you need to understand, right? When to measure the fair value is dictated by the other accounting standards. Then what is the role of this SLFRS 13? It provides guidelines on how to measure the fair value. That is the most important thing, right? The fair value measurement, it provides a one single reference point. When all the other accounting standards mention that if you need to measure something at fair value, then they need to come to this SLFRS 13 and see how we can measure a particular asset or liability, income, expense, even equity at its fair value. So therefore, the role of this or the main objective of this SLFRS 13 fair value measurement standard is to dictate how to measure the fair value. When to measure the fair value, it is something taken care of by the other accounting standards. So therefore, we have seen that the role is of the fair value accounting is the measurement of transaction at initial recognition, subsequent measurement, and the recoverable amount. And when it comes to these instances, that instances is dictated by the other accounting standards. So this is the most important thing that you need to understand, right? ඒතකොට SLFRS 13 වල තියෙන කාර්යභාරය තමයි එතනින් කියන්නේ නෑ මොන වගේ අවස්ථාවලදීද fair value එකට measure කරන්න ඕනේ. ඒක කියන්නේ අනිකුත් accounting standards. LK 16 වල කියනවා revaluation model එකට යනවා නම් ඔයා fair value එකට ගන්න ඕනේ. LK 40 වල කියනවා fair value model එකට ඔයාට යන්න පුළුවන්. LK 41 වල කියනවා yes you can, you need to measure the biological assets and agricultural produce initially at its fair value. SLFRS 9 කියනවා all the financial instruments need to be measured at fair value. So therefore, the other accounting standards would basically say that when to measure the fair value. Is it at the measurement at recognition or is it at the measurement after the recognition? Then what is the role of SLFRS 13? It says that how to measure the fair value. It basically defines what is the fair value. It sets out a single SLFRS, a framework for measuring fair value. So it basically provides you the guidelines on how to measure this fair value. And also it would mention some of the disclosures that would require. If you go for some fair value based measurement, so it would mention, yes, what are the additional disclosures that you need to make? Apart from the ones that a particular accounting standards would require, the SLFRS 13 would need some additional disclosures to be made. So it specifies what those disclosures. If you go for fair value, so what are the additional disclosures that you would require to make? So that is basically the main objective of this SLFRS 13. Get that? Any question